Welcome to Trading Nation. I'm Brian Sullivan. Stocks making record highs, just inching closer to Dow 20,000, just as our next guest predicted. But where does Tom Lee see more value this year? He is head of research at Fundstrat Global Advisors, and he joins us now. And Tom, you've got a new report out on your top sectors for the year, and a rather interesting acronym for where to invest. I would say carp, the fish, but it's we're going to flip a few of the letters around.
Yeah, that's right. I mean,
Buy the crap.
Yeah. Brian, we spent a lot of time thinking about how you're going to make money in 2017. As you know, 2016, while the market was up double-digit, the real opportunity was buying the groups that gave you that plus 20% kind of return. In 2017, I think it's all about finding companies with real earnings growth and multiples that are below the S&P.
Yeah, and we're showing you the CRAP. That's a real thing. Computers, resources, American banks, phone carriers. The last two make, they're pretty self-explanatory. Resources, what does that mean?
That's energy and basic materials. Both are benefiting from that shock fading, the commodity shock we had a couple years ago, and the dollar not being the same type of headwind. So they're, energy is going to post 300% earnings growth in 2017.
Well, up from a very, very low base. Are you not
Correct.
Concerned about that?
I think as we discussed in our report, it's really about the margins. If energy companies' margins just go back to the median, right? So in other words, they get costs aligned with their revenues, that's $7 swing in the S&P. That would actually be a seven-fold increase in profit. So a 300% increase is really just sort of recovering some of the cost misalignment that you've seen the last year or so.
Yeah, and then when I saw computers, I thought that seemed like a sector from the 90s. I'm going to get a dude at the Dell, but what do you mean by computers?
Yeah.
It's a very broad sort of focus.
That's right. I mean, and I'm dating myself using computers, but really what we're talking about is industrial technology, because wage inflation is what's really driving the uptick in inflation expectations. That's something you haven't seen since the 50s. In past inflation cycles since the 50s, capacity usually gets tight, then the labor market gets tight. So we think automation's a big theme, and that's why we want to be long computers, because in the 50s, for 10 consecutive years, technology outperformed when wage inflation picked up.
Okay, yeah, and overall, what is your biggest risk for the year, Tom?
Well, I think there's two, Brian. One is, and I think this is something most people aren't following closely, the long-term yield curve, we really rely on the bond market for a lot of signals in equities, is giving us a foreboding signal. It's really flattened since Election Day. And as we discussed in our report, it's rarely led to positive outcomes. When the curve flattens like this, it tends to slow capital spending. And of course, the other risk is if policy, we have now risk in both government policy and fiscal. So I think it's a riskier year on a policy front.
Riskier year in the policy front. I think never a truer statement has been made, because even with Trump in the trust me, I've been in D.C. a few times recently, and it is the difference between the GOP and Trump is wider in some things than many people think. But we love your acronym, Tom. Thank you. We can't probably say it on cable, but this is the web. We can say whatever we want. Tom Lee, thank you very much. We appreciate it. Folks, thank you for watching Trading Nation. I'm Brian Sullivan. Take care.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.